Welcome back to The Explainer. Today we're diving straight into a highly specific, totally foundational piece of the SASB Sustainability Accounting Standard for asset management and custody activities. We are looking specifically at how asset managers actually quantify and disclose their ESG incorporation. By the time we're done, we'll have decoded the exact anatomy of metric FNAC410A.1, and you're going to leave with a crystal clear understanding of how this reporting really works in practice. Let's get into it.
So here is the million-dollar question for asset managers today. How do you prove your ESG strategy isn't just some glossy marketing brochure? Well, without rigorous quantitative metrics, ESG claims run a massive risk of being labeled as greenwashing. Investors today, they don't just want to hear that you care about environmental, social, and governance issues. They want to see the receipts. They want to see exactly how much capital is being directed by these principles.
Here's how we're breaking this down today. First, why ESG reporting matters. Second, the core metric explained. Third, 3 ESG investment strategies. Fourth, the breakdown by asset class. And finally, the rules for calculating AUM.
Starting with Section 1, why ESG reporting actually matters, looking at fiduciary duty and long-term value. The source material makes this point absolutely clear. Asset managers have a strict fiduciary responsibility to their clients to incorporate an analysis of all material information into their investment decisions. And today, non-financial forms of capital increasingly drive a company's actual market value. Just imagine a company getting hit with massive regulatory fines for pollution, or maybe facing severe reputational damage from terrible labor practices. If an asset manager ignores these types of ESG risks and opportunities, they're probably going to see diminished portfolio returns. Over the long term, that failure could literally result in a massive outflow of assets under management, lost market share, and lower fees. So tracking this stuff, it isn't just a box-ticking compliance exercise, it's about preserving long-term value.
Moving to Section 2, the core metric explained. It's time to meet FNAC410A.1.
If you look closely at the structure of the SASB framework itself and locate the matrix row for incorporation of environmental, social, and governance factors, you will find our metric right there, FNAC410A.1. But notice the category? It says quantitative. That's huge. This isn't a flowery narrative discussion about your corporate values. This is a hard numbers disclosure measured in your financial presentation currency.
The primary goal of this metric is absolute clarity. You have to disclose the exact amount of assets under management, broken down by specific asset classes, that actively employ distinct ESG strategies. So you're literally tracking the dollars managed under these principles. Now, AUM here is broadly defined as the total market value of the assets managed by a financial institution on behalf of its clients. But how exactly do we prove those dollars are genuinely working towards ESG goals?
That brings us to Section 3, the 3 ESG investment strategies, or as I like to call it, the what.
Think of this standard as a giant sorting hat, requiring asset managers to categorize their AUM into 3 distinct PRI-aligned strategic buckets. Strategy number 1 is the integration of ESG issues. The crucial keywords here are systematic and explicit. So this isn't about an analyst occasionally skimming a sustainability report when they have free time. No, this means material ESG factors are formally baked into the investment analysis and the final decision-making process. Picture a portfolio manager actively adjusting their discounted cash flow models to explicitly account for an upcoming carbon tax or future water scarcity risks. That's integration.
Strategy number 2 is sustainability-themed investing. This one is way more targeted. While integration is usually about managing risk across a broad general portfolio, thematic investing is all about targeting specific solutions. This bucket is purely for investments directed towards sustainability outcomes or trends. The standard specifically highlights examples like clean energy, green technology, or sustainable agriculture. If the capital is explicitly deployed to chase a green or social theme, it lives right here in this category.
And then we have strategy number 3, which is screening. Now, screening isn't just about saying no to things like tobacco or weapons, though, to be fair, negative exclusionary screening is a big part of it, but it's also about saying yes to the best-in-class performers, where you actively go out and select the top ESG performers in a given sector. Or it could be norms-based screening, where you're evaluating companies against minimum standards of business practice and international norms before you ever commit a single dollar to them.
All right, Section 4, the breakdown by asset class. This is the where.
The standard absolutely does not let you get away with reporting one massive, opaque AUM number. You actually have to visually and mathematically slice your data into 4 mandatory asset classes. Slice 1 is equities. Slice 2, fixed income. Slice 3 captures cash equivalents and money market instruments. And Slice 4 is other, which catches alternative asset classes like real estate and commodities. So why does this granularity matter so much? Because it completely prevents asset managers from hiding non-ESG compliant assets in some obscure alternative bucket while loudly bragging about their perfectly green equity portfolio.
And this is where the whole metric beautifully comes together to create a rigid reporting matrix. You've got your 4 asset classes as rows and your 3 ESG strategies as columns. This cross-referencing forces an incredible level of transparency. An investor can look at this exact matrix and immediately see, okay, they have $50 million in thematic equities, but absolutely $0 utilizing ESG integration in their fixed income portfolio. It just totally eliminates the guesswork. Here is another crucial nuance you definitely want to catch. There is absolutely no hiding behind portfolio types here. A lot of firms mistakenly assume passive funds are somehow exempt from deep ESG scrutiny, but the standard explicitly states this disclosure applies equally to both passive and active strategies. Whether you have a whole team of portfolio managers actively stock picking based on ESG integration, or you simply manage a passive index fund that tracks a best-in-class ESG benchmark, you are required to do the exact same quantitative math and report those assets. No exceptions. Section 5. Rules for calculating AUM. We've covered the what and the where. Now let's talk about the how.
If you are the person who actually has to put this report together, here is your practical playbook. Step 1. Define the total market value of the assets managed on behalf of your clients, and make sure you express this in your financial presentation currency. Step 2. Disaggregate that total pool strictly into the 4 asset classes we just talked about. And Step 3. Categorize the AUM in each of those classes by the 3 PRI-aligned ESG strategies. Boom!
But wait, what if a specific fund uses exclusionary screening to dump fossil fuels and actively integrates ESG scoring into the remaining stocks? Well, the SASB standard anticipated that exact scenario. You must identify and explicitly disclose the amount of any AUM managed using more than one ESG strategy. This overlap rule is absolutely vital for ensuring transparency and preventing double counting. Think about it. If you double count an asset that uses both screening and integration, your total ESG AUM looks artificially huge. And to regulators and savvy investors, that looks a whole lot like greenwashing.
The asset management industry is evolving so incredibly fast, and the old dividing line between financial and non-financial data is rapidly blurring. This specific SASB metric provides the exact methodology to quantify what a lot of people used to think was basically unquantifiable. So if non-financial capital increasingly drives your market value and your long-term returns, the real question is, can you really afford not to rigorously measure it? Thank you so much for joining this explainer. Keep learning, keep analyzing, and we'll catch you next time.